today, October 19, we detected unusual options activity on the energy sector ETF, XLE, and in this video, we will show the data to explain why we think trading energy is a good hedge for the current stock market conditions. You can see here that the media pointed this out a few days ago. Also that the investors are bullish on energy stocks. Oil is soaring because of the Middle East conflict. And so, as usual, we follow the data, not the media, but we want to trade only based on data. And if the media says something, we always want to use data to confirm it. Okay, so let's take a look at the data today to explain why we think this is a good trade here. So for the options time and sales tape, we detected about an hour ago at 2:09 these 20,000 unusual options. You can see that they were being done for the year 2024, June, 70 strike puts, 100 strike calls. Now, we also monitor stock sales as well. So this here we have other monitors where we watch stocks being traded. And so this is the stock sales for time and sales as well, just like the options. However, you can see that this actually isn't recorded. The most you can see is actually just about 10 minutes. You can see that if we scroll all the way down, only 2:57 p.m. is the most. That's just about 10 minutes ago, because this is not this window. You have to monitor this throughout the day. You cannot pull this window up to look at past data that's greater than an hour. So it's very important that you can monitor stock purchases as well to see whether or not options are being used to hedge. And so that's what we do. And so that's something very important, because sometimes options are just being used as hedges, and you want to make sure that there was no stocks being purchased, so that you know that these stocks are actually a directional trade instead of a hedge. Okay, so if you are interested in the data and the analysis that we do, make sure to subscribe and hit the bell icon, and you'll be notified of unusual options activity such as this. So let's get to this, because we saw that at 2:10 p.m. right after these options, they bought stocks to complement these options. So let's take a look at the options chain to dig a little deeper as to what they were doing. So here is the 70 strike puts for the June 2024s, expires 246 days away. These puts are being open because it's greater than the open interest here. We believe they are buying these 70 strike puts. And at the 100 strike puts or calls over here, you can see the 20,000. It's greater than the open interest. Okay. Over here, we believe they sold the 100 strike calls. And what they also did was, as we mentioned, they bought stocks. So when we analyze this option trade, you can see that this is what it looks like, but we know they bought stocks as well. So we have to add this into our analysis to get a more accurate picture of what was being done. So 100 shares of stock is equal to 1 option contract. And so this is the trade that they did. You can see here that as the price of XLE goes up, they will be profitable. And if it stays where it is, they will also be profitable, since they have a positive theta that gains in value. You can tell from the delta positive that they are bullish and long on this trade. And you can see that their break even is actually over here, $88. It's lower because they traded these options. These options that they put on, you can see, reduces their break even. When we put these on, you can see that the break even now shifts down lower. And so that's one of the advantages of trading this options strategy that they're doing. You can see that it actually, if they did not have stocks, each of these contracts would have cost a buying power. This is the buying power here. It's right here. So this is, you can see that the buying power is about 1,500 for this trade, right? And we know that they did 20,000 of them. So 20,000 contracts, that's $30 million, right? And since they have shares of stock, they don't need to put in additional buying power, because they're using their stocks as their essentially their collateral by selling those 100 strike calls. It's like a covered call, right? Currently the price at $92. Then they're selling the 100 strike calls as a covered call. So you can see what they're doing here. They're essentially selling those calls that are out the money, collecting this $500 for each of the 100 shares of XLE that they have. And then they're taking some of that credit, that $500, and buying the put options at the 70 strike for about $130 to hedge the potential downside in case XLE does go down. You can see that here as the price goes down. Let's say it goes down to 70, you can see the loss of $1,200. If they didn't have this option trade, you could see their losses at $2,100. So a lot more loss without this hedge here by selling these calls, options, and then buying those puts. So this is what this large institutional hedge fund is doing today. And we wanted everybody to know about that and to see this data happening in real time. And so if you are interested in this type of data and this type of analysis of what we do, you can watch a lot of our previous videos on how we predict stock price movements and other stocks as well, individual companies. If you're interested in that type of data where we follow the trades of wealthy, rich investors, make sure to join our membership by clicking the join button on our channel homepage to get an edge with the data so you can trade in the right direction, whether the stock is going up or down. We're able to predict it with higher probabilities because we can follow this data and analyze it and interpret what this wealthy trader is trying to do. So to learn more and to get access to this, make sure to join our membership by clicking the join button on our channel homepage where we share these exclusive videos. And as usual, please smash that like button and subscribe if you haven't. Hit the bell icon and you will be notified of further unusual options activity. Thank you and take care. Have a great day, everyone.